3 signs of trend exhaustion and how to profit from them. I'm going to show you some of my trades this week. I trade most markets under the sun: oil, gold, futures, forex, stocks. Not an options trader. Why don't you trade options if you trade everything else? I always get that question. You know what? I'm really good at what I do. So options, it's another field you have to learn. You've got to learn something else. So only so much time in the day, and I've got a 7-year-old. So you know what? I'm just going to stick to what I know and can do well. So I do have a lot of options traders that I work with because they apply my techniques to their options. Things like time development are really important, understanding so that you're dealing with time decay, knowing when a move is most likely to take place, how far that move is likely to go, and if it's gone too far, hey, now it's more likely to fail. Things like that are still important to understand if you're trading options. So without further ado, let's dive into our 3 signs of trend exhaustion and how to profit from them. Don't bet the entire bank, you guys. That's my disclaimer there. Okay, here's my mantra. And this is what I started with from trading. If I can't explain why I am taking a trade, I should not be in it. So when I started trading, I knew things like bull flags and bear flags, just very basics. There wasn't much for advanced technical analysis. And I would see something that looked the same on one chart work, measured impulse waves. So this is the most simple concept out there. How many of you guys are familiar with measured moves in the market? Come on. Measured moves. Yes? No. Okay, who is not familiar with measured moves? Okay. And everybody else is sleeping already. More coffee. So measured impulse waves, this is a concept that is so simple that once you see it, you can't unsee it. What it is we are looking at basically these moves in the market. So an average to stronger than average swing back and forth in the market is called an impulse wave. So A, B, C, D, E, these are all impulse waves. They are main trending directional moves where you have momentum that is average to stronger than average. What's average? Average would be just a really simple visualization of average. If you look at your chart and you see a V or an inverse V, each side of that V is pretty close to what an average momentum move in the security is. So if you go back over time, you look for periods of congestion where there's a lot of back and forth, that's going to give you a really simple visualization. That's the easiest way to explain it. There's more details that can go into it, make that concept even clearer, but for our purposes here, V is going to be our measured impulse wave. So D and E is a really good starting point because that gives us our inverse V. So these are impulse waves in the market. And what's interesting about impulse waves is that they like to repeat themselves. Not only the same price development, for example, 5 points, 5 points, 5.25 points, 5.5 points, 4.75 points. You will see them come in really, really close. And the number of times it has hit measured impulse moves to the tick is more than I can even count. You will see them hit that close as long as the momentum is about the same. So if your momentum on A, as shown on purple, starts to break higher again on B, same momentum or same pace of change, you have a pretty good shot that at the high of C, you're going to see some sort of correction move trying to happen. It could be anything from a shift in the buying so that it starts to have a harder time trying to move up. It could be going into a flat base, so it's correcting over time, or it can pull back, like you see here where it pulls back in price. This is partially price, partially time, because it's a slower pullback on 3 than we saw on 2 and 1. But I copied and pasted each of these bars. So the different variations that you're seeing between the highs and the lows, that's because those are just differences in just how many ticks it is compared to being the full measured move. And look at how close every single one of those are. But you have different impulse moves on different time frames. So you've got smaller impulse moves that will repeat, and you've got larger impulse moves that will repeat. This is really important because if you're focused on just one smaller time frame, you might be hitting a measured impulse move on that time frame. You go up to a bigger chart, you might be in the very beginning stages of a bigger impulse move. So it might stall, pause, and then end up breaking down because of what's going on the larger time frame. So let's go on over this. This is basically what I said. When momentum on an impulse wave is nearly identical to the previous impulse wave, then the odds of it holding a comparable price swing as a target is high. So very simple concept. This is a chart where I gave this class in Vegas, and every time I give a class, you guys, I will repeat classes over the years, but I totally redo the classes. And then I pull examples from the previous session to show you guys how it follows through. So this was the chart that I gave them in Vegas, where we were looking at the breakdown coming off of that high in May. And you can see I looked at previous impulse waves and major swings taking place within the larger moves. This is the exact slide that I used. And notice I have my impulse move down and a question mark. It hadn't made it to that point yet. Want to see where it stopped? Here's the level. So I put this on here so you can see it as you compare it to the other chart. Look at where it stopped. Look at how close that got to exactly what we were looking for before it bounced. Exact same price level. That is how well this concept works. And this was just the chart that I took that very day ahead of that presentation. So you guys will see me do this in most of the classes that I do. I will pull stuff. So I will show you things that I did in previous classes, how they played out, and then I'll give you something to look for as you're going into the next session. So here are our support levels. And also look at this on the smaller scale. So within this, we had the bigger impulse waves, which were shown in blue, but then we also have the smaller ones shown in purple. So you've got a two-wave measured move on the purple side of things as well as we are heading lower into that low. So that is also giving us a major support level. So you have got both of them working together, not just the larger impulse wave, but also the smaller. And that goes into trend development as well. We're going to be talking about that here in a minute. So here's what this looks like now. On the bigger scale, this is the US Canadian dollar pair. And the bigger chart there is where we are at right now. So the bigger chart has a box right here. And that box is just all the data that we were just looking at. So the back and forth data of the smaller impulse waves was in there. So this shows you, hey, if this breaks down, these are some of the potential levels of support that we could get. As long as the momentum breaks, similar to the purple and the blue over here, this could be our next target level on the US Canadian dollar pair. We're going to look for short setups taking place on some of the smaller time frames. For example, a base here. At 5, if this base is out, it triggers a pattern called an avalanche. I handed out that template, guys, all around. If you don't have a copy of it, you can get copies up here. The avalanche is the reverse of that phoenix. So if you take that pattern that I gave you, you flip it over, then you've got the avalanche. So it's just the pattern in reverse. And I went very detailed on that template for you guys because I get lots of questions on it. So wave count is the next thing that we are looking for. Do I mean Elliott wave? Sort of. So I was not at all introduced to Elliott wave when I first started trading. In fact, I didn't really know much about it until probably a good 5 years into trading, but I did notice wave count. And I do wave count a little bit differently. So trend development can be one of the trickier things for people to learn. And it takes a lot of time to learn it well, but there's a lot of basic things that you can start with that you can put together that will build upon each other. So here's what typical Elliott wave theory looks like. You're looking at 5 wave moves, 1, 2, 3, 4, 5, and then an ABC correction. So when I'm looking at this move, I'm not counting 5 waves. I'm counting the 3 waves down, and then I go into thinking of corrective mode at that point. So for me, one of the important traits of a trend is how long does it take each of these corrections to form? So from 1 to 2, here, how long does that take? Does it take half an hour? Does it take 45 minutes? If it takes about, let's say, 45 minutes, then from 3 to 4, does it take another 45 minutes? That tells me that I have a good shot of another third leg down. If they're not the same, then I'm going to be shifting my trend development and my wave count. I focus more on 2 wave count than I do 3 wave count. And the reason is that if you look at this same move, and let's see, I'm going to pull a drawing tool up here. Go to the other slide. Where'd it go? Here we go. Drawing tool. All right. So if I go down here, this goes into this correction, right? Well, if this pulled back a little further, I might go into a correction here, pull down here, base out here, and then go down. So instead of getting 3 waves down, I end up with 2. So it goes into a 2-wave correction. And then that's the end of the trend. And these can be the exact same size. So this can go like this in one situation, and then it can have the 3 waves in another situation. So a lot of times that middle movement in a 3-wave trend development, I'm actually counting that as part of the correction. Because sometimes your trend will look like this: bigger here, shorter here, bigger here again. So this is really my entire corrective move. It's a little bit of a different way of thinking about things. But you're going to find that if you adjust your thinking that way, that you're going to avoid a lot more of the false wave counting that you could run into. So I'm thinking of this as wave 1, 1-wave correction. This is part of the correction. 2-wave correction, and then 2 for the continuation. So just a little bit of a different way of looking at our trend there. Those of you that follow me live, you're going to see this as a theme over and over again. Of course, trends aren't always this pretty. A lot of times they might look like this. How many waves of buying are on this chart? One guess for 4? Who would say 3? You would say 3? Good. Who else? You would say 3? Good. Anybody else vote for 3? I vote for 3. Let me show you. We're going to clear this up here. This is a time frame chart. So I use both time frame and tick charts. Sometimes you're going to see data better on one than you will the other. Here's the tick chart. This is the 2000 tick chart. If this is the MNQ, so showing you the same data as the NQ. So my wave counting is going 1, 2, 3. This amount of time here for the correction is about the same amount of time as the correction over here. That's what's leading my wave count. This correction in here is shorter. So that means that for me, this is a 2-wave move in the middle. We've got a 2-wave move to start, a 2-wave correction, 2-wave to continue, 2-wave correction that has a double top, and then 2-wave continue. So I'm thinking 2s and 2s and 2s again. Let me clear this up for you. So here is the main chart. And again, pay attention to how long correction periods last. And if you have 2-wave corrections in those correction periods, that's going to help you clear up your wave count. Going into this a little further, each of those 2-wave moves up within have two waves as well. So when I see two waves up, I know, hey, I could go into a corrective mode. If this is a downtrend or trading range, more likely it's going to be a sideways correction, but I could still get some scalps in it. But then I want to see another two waves up before I try to do any sort of exhaustion type of move. There's only one wave right here. So I need to have a second wave up, preferably a second measured wave up. So if I can get those measured waves, that's going to clue me into short-term trend exhaustion again. Over here, I was looking for a slightly higher high because we didn't quite get a measured move there at that point, but momentum shifted in here and it still triggered a reversal. So even though we've got the three moves up, this wasn't a perfect trigger. I did still take it, but I took it based upon something that was on a smaller time frame. And I'm going to show you that smaller action here. So here's the pivot, again thinking in waves of two. So I had a pullback here, kind of popped, and then momentum picked up. So I was a little bit aggressive. I do a lot of pivot trading, but the core setup that I teach my traders and the one that we followed live was this setup here as the continuation. So the trend development, the wave count, the measured impulse moves, that's what got us up to this high here in the first place. But it took momentum shifting to really get things to turn around. Here's another example showing you how the measured impulse moves play out. And here is a bit of that shift in momentum. This time, again, we're back on the 30-minute time frame. So you can see the change in the momentum a little bit at the highs. It starts to round off. Basically, this is forming what you guys might be familiar with as a cup of handle, an inverse cup of handle at the highs. It's kind of tricky unless you're starting to think again in terms of the two wave count. So if you're looking at, let me clear this, two wave count here, one wave in the correction, two wave in the correction, that triggers the short. This is something I call a tilted avalanche because it is that avalanche pattern, but the move is tilted to the downside. So we actually followed this pattern live. I gave it ahead of it even triggering. And we walked through what would be pros and cons for buying it and why this was most likely to fail, why it was most likely to go ahead and break down. Momentum is a big factor. When you have slower momentum on the upside, following stronger momentum on the downside, and it shifts and rolls over, you're more likely to get a really strong continuation on the downside. So this can help build that momentum and really get things going along with that wave count. And this wave count is over and over again. So scalpers love it when you're in a market, a volatile market like we are in right now. At the highs, you will see this type of action playing out on the daily and the weekly time frame, back and forth. Count two waves back and forth. Even in here, two waves up, two waves down, shift. Two waves up, shift. You can count those waves over and over again, and they're going to help you with your positioning. So I'm focusing more on two waves than I am focusing on three waves. So the third sign of trend exhaustion is that momentum shift that I just mentioned. So here is Friday's action. Once again, I was short. What we are looking at is really strong momentum midday. Here, nice sharp two-wave move going into the end of the day, the previous day. Overnight, momentum shifts. We get this nice strong momentum shift. Here things get tricky. We're going into a widening wedge. When you're looking at a wedge, the greatest way to determine momentum is to transect the congestion. So draw a line right through the middle, and that tells you what that momentum is. So even though we've got these little spikes in here within this wedge, it is still more of a sideways trend here that is starting to tilt to the downside. So we're constantly shifting that momentum with each of these moves.
Where did you get shorted from?
I shorted in a couple places. Let me show you here. I'm going to clear this. So I shorted overnight.
Oh, 15, okay.
Yeah, I started overnight here because we had this shift and there was a little avalanche. Again, the avalanche is the opposite of that phoenix pattern. And then again here on the, yes, so this is a megaphone pattern. So how I trade the megaphone is this is 1, 2, 3, 4, 5, and I short at 5. And this is a more advanced strategy because it's often a pivot trade and it goes really fast. So yeah, for new traders, I don't recommend trying to go for it because you can get hurt if you're going the wrong way because you're going against momentum a lot of times. Yeah, it's a great place, and you can count the waves in that move too. So there were actually 3-wave movement up within that last move up, and it came up to the upper end of your channel there. There was Fibonacci resistance too on larger time frames, Fibonacci retracement and extension levels there. So those were helping provide that as a strong level of resistance. That's what helped me short early initially, and then I just built into the position. And then I also added at the end of the day, it was like right ahead of the close. Yeah, I was one of those crazy people that shorted over the last 15 minutes of the day on a Friday, you know. I find a lot of times setups will set up right at the end of the day, like right in those last couple of minutes. It's crazy, but you get good moves. Again, newer traders don't trade the last 15 minutes or so of the day or right after because you're dealing with news. News can whip you, it can whip you fast, it can really hurt you.
What is the average amount of time you hold a trade?
It really varies. I would say maybe about an hour or 2 hours usually. But
You had a 5-day chart up and now you have a single-day chart.
I know, I do everything. I am like a jack of all trades.
What's your setup though? You're basing it off the daily chart or do you
This I have, so for something like this, I've got a daily chart up, I've got a 240, I've got a 20,000 tick, I've got a 30-minute, and I'll have like even like a 500 tick or a 200 tick.
And when you're shorting the puts or do you actually short?
I short straight up. Yep. Not really. It depends. So I don't hold over the weekend for futures because you never know with like the global data. So when something like this, when it gets to be 4:13, I'm getting out. I don't even hold through that first little section. I only have a couple minutes here left, so I'm going to go through this fast here. So measured moves, look at the momentum and the measured move shift here. So this is another setup I took with the trend exhaustion, and this was based on the class that I did in Vegas. And you'll notice the measured move here, it makes it up to that measured move zone, but it starts to shift momentum, even though it makes it up there. Then it shifts momentum again, 2 measured moves. This is another key short strategy. I call it a 2T. And you will see over and over again, a lot of these setups, I am getting in at points that are very, very close to highs or lows. And I'm going to be talking about this tomorrow in my session, my longer session at, I think it's at, not the CME one, but the one that is right afterwards. I'm going to show you guys how to get in at really tight levels, but without increasing your risk. So it's going to be at, okay, it is at 130 actually. 130, it's improving trade management. So even though the session is on futures, no matter what you trade, you're going to learn from it. So if you're a stock trader, options trader, I still recommend coming by because I'm going to be talking about how to pull away from traditional technical analysis and use these building blocks of price development to get much better entry triggers so that you're going from setups that are like 1-to-1 or 2-to-1 return to reward 60% of the time to setups where you're getting like 8-to-1, 10-to-1, 80 to 90% of the time. So that's what we're going to be looking at. And a lot of times when I stop out on trade, I don't take full stops because of the trade management aspect. So it is an intermediate to advanced class, but even if you are a new trader, come because you're still going to learn the stuff that's going to get you to that next level and help you avoid so many early entries or late triggers where you end up chasing something and you're in at just exactly the wrong point. So that's what this class tomorrow is going to be on. So these are just some really basic things to start with for putting everything together. Here's another trade. You can see all of those aspects. The buy with the momentum shift, this buy was the Phoenix. So this buy is that template that I gave you. And all of the things that I looked for to take the trade at this level are in that template. So you can study that template, put up on your wall, you're going to see it over and over and over again.
It's the only kind of stuff you look at. You don't look at convergences and divergences on oscillators, none of that stuff.
I am a pure price technician. I will use Fibonacci to an extent, and that's it. Sometimes I'll have volume up, not all the time. So I learned to read pure price, but I was trained as an artist, so I teach as an artist. I teach you the components and building components together. You start your phase, hey, here you start with the circle. Then you add the details. Oh yeah, that's starting to look better, but you still need to, you know. That's how I teach too. So here's momentum shift, that got me out of the trade. Right here, I was already building out of the position here, but this confirmed it. Again, it was a two-way move, and it's actually a short reversal set up at the point two. What's that? I did not get off a candle. I use things like the measured move and exits just ahead of measured move levels. I use different like Fibonacci levels. I use the wave count to tell me, hey, is this one I've got to be more aggressive in, the trend placement? Is this a trade that I need to go for first level of resistance and totally take everything off? Or is it a trade that's going to be a total trend reversal? And I can hold for the entire day or even a couple of days.
What's the difference between yours and Elliott Wave?
I didn't study Elliott Wave, so I know like the basics of Elliott Wave. I bring in a lot of time development in it. I focus a lot more on two-wave count than three-wave count. So I did not study any traditional system of technical analysis. What I've learned about other systems is basically just what I picked up along the way from what other people talked about. Most people that study Elliott Wave, they love mine. So Elliott Wave sometimes confuses them and they run into trouble. So I try to explain everything basically. Yes?
Yeah, when the trade is going against you, what kind of rules do you use when the trade is going against you?
I have set stops. So on this position, for example, here, this is a buy setup. It's coming out of a downtrend. I look at kind of the spacing between some of the previous little pivot zones, and then I add that on and put my stop under that level. So with my trade management, I take some gains off pretty fast and then build back in. So I build into positions, early in positions. So a lot of times, by the time the trade takes off, even if it totally fails and goes the other way, I wouldn't be taking a full loss on it because of how I manage the trade in those beginning stages. And you can do that with as few as 3 contracts if you're a futures trader. The class that I'm going to be showing you guys tomorrow goes into details on that, and it's a longer class.
What is the brokerage firm that you use?
I have a TradeStation, and then I've got NinjaTrader through Phillips.
Do you find their charting system to be the best trade station, or do you use other charting systems?
They're all pretty good. I like TradeStation, MB Trading. NinjaTrader has awesome charts. My time is up, you guys, but you can hunt me down everywhere. Let me see who we've got coming up here next.